The FedLife podcast is presented by Serving Those Who Serve, a fiduciary, fee-based financial planning firm serving federal government employees and retirees all over the country. This podcast is for informational purposes only and is not intended to be taken as financial advice. All listeners should consult their personal advisors before taking any action. The opinions expressed by our hosts are their own and do not reflect the views, policies, or position of Raymond James. Securities are offered through Raymond James Financial Services, Inc., member FINRA SIPC. Investment advisory services are offered through Raymond James Financial Services Advisors, Inc. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services, Inc. And now, here are your hosts. Dan Sipe serves as a branch manager for Raymond James Financial Services and Serving Those Who Serve. Ed Zerndorfer is our guest and federal benefits expert in the space.
Hello and welcome, everyone. This episode of the FedLife podcast. I'm your host, Dan Sipe. Additionally, I'm the branch manager at Serving Those Who Serve and Elise Sipe and Associates. I want to begin, as I always do, by saying thank you. Thank you for taking time to listen. And above all, thank you for your service to the government, the country, to me, to everyone. You don't hear that enough. You will always hear it here. The other thing you're always going to hear with us is Ed Zerndorfer. The guru is back with us once again as part of our ongoing mission to reach, teach, and serve you. If you're a regular, you know, we like to follow Ed's FedZern articles to give us one more way to reach and teach. And folks, let me tell you, here we have another great example of why there is no one like Ed Zerndorfer. Ed's giving us a two-part article that you won't see anywhere else, and that's tax-smart ways to pay for a child's educational costs. And Ed, you begin with the premise with which we are all too familiar. Educating kids costs a lot, but you lay out ways to get some tax breaks while our feds do it, correct?
That is correct, Dan, and I've been through it. I have 4 children, and now I have 15 grandchildren, and I know what it's all about in terms of educating your children. We're not talking about post-secondary education. We're talking starting with nursery school through graduate school. And there are some I call them tax-favored ways to pay for your child's educational costs, starting with nursery school all the way through graduate school. That includes medical school or law school. There are some tax-favored ways. And that's what I describe in the 2 FedZone columns. And I broke it down, Dan, to 3 ways we can do this in terms of tax benefits. One is what we call exclusions from income. We'll get into some examples. We'll explain what that is. Tax deductible ways to pay for education. And then my favorite way are tax credits. I love tax credits because what is so special about tax credits? Because they are a reduction dollar for dollar from your tax liability. So
absolutely,
we'll talk about all those good ways of paying for education.
Okay. Well, I'm sure our folks are waiting with bated breath. So let's jump in with your first one, which is scholarship and fellowship exclusion. Tell us about that.
Yes, scholarship and fellowship exclusions are nothing more than money that is given to an individual who's been attending an institution of usually college or has a fellowship organization, and that money that is paid for scholarships, provided it's used to pay for tuition and fees, is tax-free. It's tax-free. Now, if they use the money for any other purposes, such as perhaps paying for books, it's not going to be tax-free. It's only tax-free if it's used to pay for tuition and fees at an accredited institution of learning. That's a college or university. There's no reason why it cannot be, let's say, for a vocational school. Someone is getting a training to do something, and they're getting a scholarship from some organization. There's no reason why that's not going to be that would be taxable. No, it would not be taxable. Again, we're talking about getting some type of certification here, including that would be most likely for someone who's attending a college or university, a degree.
Sure. Gotcha. And then how about the fellowship side of it?
The fellowship side of it, if someone is on a fellowship and they're being paid to do something. Many times you have these postdoctoral fellowships, and here in the local area, I know several people have gone. They got a fellowship to go to at the National Institutes of Health. National Institutes of Health. Those fellowships are tax-free. That is good. That is good news. But the only problem I have is that, a lot of people don't like to, pay taxes on their income. But one of the taxes that's withheld from your paycheck are Social Security taxes. You're earning credits, which later on is sort of a forced savings for retirement, and you'll get the benefit back by paying those Social Security taxes in the form of Social Security benefits. Also, when you're getting money for a fellowship, it's not considered to be wages. You cannot contribute to an IRA, fellowship income. So that I consider that to be a downside in the long term. But in the short term, it's not going to be taxable.
Gotcha. Okay. Number 2 is one that I'll admit a lot of folks may have forgotten because we don't talk about it as much anymore. And that's Coverdell accounts. So talk us through that.
Yeah, they used to be called educational IRAs, Dan. They were changed to Coverdell Education Savings Accounts, CESA, because the late Senator in Georgia, Paul Coverdell, was the one who introduced it. And what they are is that an individual, a child under the age of 17, can get contributed to an account on their behalf. They're the beneficiary of the account from their parents or any other relative, $2,000 up to $2,000 in an account. And the contributions that are made are not going to be tax deductible. But anything coming out of the Coverdell, including earnings, can be used for any type of school expenses, including nursery school, including parochial school, private school, college. The only problem is when it comes to the $2,000 a year limitation is that, let's say a parent wants to put the money in. The parent wants to put the money in, but there are income limitations for contributing to it. That is, if the parent's income is over, and I have the amounts here for this year, because it's still time to make your Coverdell Education Savings Account contribution for the year, is if their adjusted gross income is over $220,000, or in case, let's say, a single parent or anyone, because anyone can put the money in on behalf of the child into the account. The limit per year per child is $2,000, but anybody can put that in. It could be a favorite uncle, a favorite aunt. And in case of single individuals, if their adjusted gross income is over $110,000, they cannot put the money in. But let's say there's no one who is eligible to contribute because their adjusted gross income is too high. Very simple solution, particularly with a parent. It's very simple. The parent can gift the $2,000 to the child, and the child can put the money in. Okay, so that would be the solution to that problem. We're not talking about a lot of money here, $2,000. It can be invested. You can go to a financial planner, a broker, investment broker who can invest the money. And the idea being that the money should be invested somewhat, I think, aggressively, because any money that's left over, let's say after the child gets out of high school, can be used for college.
Okay. No, that's great. Number 3 is qualified tuition program. That's 529, correct?
That is correct. Dan. Every state has a 529 plan, and the beneficiary, these plans are set up for a beneficiary, usually a child. And there are 2 types of 529 plans. What are called the prepaid tuition to tuition programs, that you prepay tuition. You're guaranteed a tuition rate when you're contributing to the plan. The college that you wanted to say the child wants to go to, you would be guaranteed, given the money, the amount of money you're putting into the plan. When the child attends that college, they would be guaranteed the amount for each year of college. The amount is. There have been some problems with these prepaid plans because the colleges many times underestimated the cost of education.
Sure.
A better way to go is what's called the 529 savings program, in which you can invest the money with a brokerage on behalf of the child. Now, the good news is that there's no limit as far as adjusted gross income, who can contribute to the plan. Usually the parents contribute to the plan, but the grandparents can contribute to the plan. There is a limit each year how much you can contribute to the plan. That's per person. And that is the gifting limit, which is this year, 2024, is $18,000. You can gift any one person $18,000. But In the case of a 529 plan, yeah, it's $18,000 per donor, but the IRS now, over the past years, has allowed up to 5 years worth of donations. So that's $90,000 can be contributed to a 529 on behalf of a child. And if a person's married, double that. That's
Sure.
$90,000 response for $180,000. They're very good. It's a good way to pay for a child who's the beneficiary's future college costs. The question comes up when the money is withdrawn. The contributions that were made with after-tax dollars. There are no tax benefits when the money goes in on the federal level. Some states with their 529 plans allow a tax deduction or a tax credit up to a certain amount. I know here in Maryland, the Maryland 529 plan, you can get a tax deduction. I believe it's $2,500 per beneficiary, up to 2 beneficiaries. If you donate, if you're a Maryland resident and you're donating to the Maryland 529 plan, it's a tax deduction. Now, whether the contributions are deductible or not deductible, in the case of federal, they're not deductible, but all earnings withdrawn from the 529 plan are going to be tax-free, provided they're used to pay for qualified educational expenses for college. We're talking tuition and fees, room and board, books, supplies, transportation costs, the money taken out provided to use to pay for something that's related to individuals' college, university education, or vocational school. Once again, vocational school, it's called that the expenses that are incurred to pay for vocational school are going to be the money coming out of the 529 plan will be tax-free.
Gotcha.
Now, the question comes up many times, well, I really did an aggressive job contributing to my child's 529 plan. And the child went through 4 years of college, and still there's money left over. There is money left over. So what happens then? If the child may want to go to graduate school, law school, medical school, the money can be used for that. What happens if the child is not going to go to pursue any more further education? Then it's allowed to transfer the 529 account, 529 account that the child had to a child's sibling, a brother or sister, or even to a cousin. Maybe the parent wants to go back to school. That's possible too.
Sure.
Also, starting, I believe, this year, under Secure Act 2.0, Secure Act 2.0 that was passed back by Congress back in December 2022, any leftover money in a 529 plan can be transferred to a child's Roth IRA. But Dan, I will tell you, it is complicated. If anybody's thinking about doing that, please talk to a tax advisor. Do not do this on your own. There are a lot of requirements here, and do not do this. It just came out. It started January 1st, and there's still some unanswered questions, so don't pursue this.
Gotcha.
Don't do this until you talk to a qualified tax advisor.
Good tip. Now, number 4 involves something that I know feds everywhere know well, and that's savings bonds. So what are the benefits here?
With savings bonds that an individual over the age of 24 had bought, these are EE bonds or I bonds, sometime after 1989. The law took effect January 1st, 1989. As you know, Dan, when you buy a savings bond, you buy it at a 50% discount. At least that's what you used to do. I think it changed now because now everything's online. You buy them at full face value. But the point is, they accrue interest over the years. And then when you cash in the bond, you'll pay tax on the interest income, the accrued interest. Now, under this savings bond interest exclusion, that if parent owns an bond, it has to be in the parent's name, and the child is going to go, let's say, going to college, university, if they cash in the bond, and the interest is used, the interest income is used, the proceeds from the bond are used to pay for, I got to make sure I got the right thing here in terms of, is used for qualified tuition and fees. Again, there's sometimes these educational benefits can only be used for only certain types of higher education expenses, in this case, tuition fees. Then the interest that the part of the bond that's used to pay for tuition and fees will be tax-free. This is when you cash in your savings bond. But then, like many good things, many good tax benefits, there are AGI qualifications you must fulfill. If your AGI, when you cash in the bond, you own the bond, and you cash in the bond, and your AGI is too high, your adjusted gross income, you won't be able to get the tax-free treatment of the interest that is used for tax repayment. Let me give you those AGI, because they go up every year. For 2023, they happen to be for married filing jointly. If you're over $167,800, this is married filing jointly, you cannot cash in that savings bond tax-free to use for qualified tuition and fees. If you are single or had a household, you cash in the bond, and your AGI is over $106,850, you cannot get the tax-free treatment when it comes to cashing in savings bonds to use for tuition and fees for a college university.
Gotcha. Your number 5 looks like it's primarily for younger children, and that is dependent care assistance plan. So how does that work?
Yes, it's called a dependent care assistance plan, in which an employer will pay up to $5,000 to an employee to use for qualified dependent care expenses. We're talking about things like nursery school or day camp. It's almost identical to the dependent care, IRS's dependent care tax credit. You get a credit for qualified dependent care expenses. Well, in this case here, it's the same type of expenses. We're talking about nursery school. We're talking about before and after school care for a child under the age of 13. The child has to be in the age of 13. Or it could be for, let's say, a dependent spouse. The spouse that has to go to an adult daycare center.
Gotcha.
Or let's say an employee has a parent who they claim is dependent who has to go to an adult daycare center. That money from the dependent care plan can be used to pay for it. Now, that $5,000 is all going to be pre-tax dollars. It reduces the employee's income by $5,000. The problem is, Dan, we're talking about the $5,000 is going to be from 1 to 5 dependents. $5,000 in this day and age for child care and adult daycare doesn't go very far. I know I have clients who use the child and dependent care tax credit, and they have 3 children.
Sure.
3 children. They end up using the $5,000 by February. They still got the rest of the year to pay for it. It's not much. Realize this limit, $5,000, has been increased in 23 years.
That's probably due. Probably due. Now, number 6 involves one of your favorite topics, and we'll talk about in our next podcast. But that's using Roth IRAs. Tell us about that.
Yeah, you can do it. I'm not thrilled about it. Let me explain why. Let me just explain what's going on here. When you contribute, or when someone contributes to a Roth IRA, the contributions that you make to the Roth IRA are not deductible. It's non-deductible. You're using after-tax dollars, and you put the money in. And the Roth IRA accrues earnings depending on how you invest it, dividends, capital gains, interest, however you invest it. And you can pull the money out of a Roth IRA after 59.5 tax-free. Now, the contributions, Dan, were already taxed, so that's not surprising. But the earnings from the Roth IRA you can pull out tax-free, provided you're over 59.5. The contributions that you made, because they were used with after-tax dollars, can be withdrawn anytime, tax-free, anytime, to be used for anything, including for educational expenses. Why am I not thrilled about that? Because the longer you leave the contributions in, the more time it's going to accrue tax-free.
Sure.
So
gotcha.
It's there. It can be done tax-free, but still, I'm not thrilled about it.
Okay, so I'm going to kind of guess here that your next one up, which is actually from the second article, is using deductible contributions and penalty-free distributions for traditional IRAs. Are you not wild about that one either?
I'm not wild about that one either.
Okay, so tell us about it.
Okay. All right, here's what the law says. Let's talk about deductible traditional IRAs. When you contribute to a traditional IRA, your contribution that you make may be deductible. Now, I say maybe because if you're covered by a pension plan, and all federal employees are covered by a pension plan, whether it's CSRS or FERS, federal employees contribute to their savings plan. Okay? So if you're covered by a pension plan and your adjusted gross income, once again, back to AGI, is too high, you're not allowed to deduct your contributions. Now, typically, younger people, let's say young federal employees, and they come in, their adjusted gross income is not that high enough that they would be allowed to contribute to a deductible traditional IRA. And let's say they do. And over the years, they're not able to contribute to it, but those contributions that were made to the traditional IRA were, in fact, initially deducted, and they grew tax-free. IRS says that you can withdraw money from your traditional IRA before age 59 and a half and not have to be subject to a 10% early withdrawal penalty. You can pull it out tax-free for a couple of reasons. But one reason is to pay for qualified educational expenses, higher education expenses for members of your family. That would include your children and a spouse. And you won't have to pay a 10% penalty on the contributions and the earnings you pulled out tax-free. I don't like that. Once again, Dan, what is the purpose of contributing to an IRA? What is the purpose of it?
Build money for retirement.
For retirement. Not to pay for your child's consequential education. Okay?
Gotcha.
I always say this many times when giving seminars and webinars. When it comes to paying for higher education expenses, and I've got many questions. Can I take out a TSP loan to pay for my child's college education? It's called a general purpose loan. The answer is yes. You can do that, and there are no tax consequences. You just pay back the loan. Why don't I like that? Because the money you're pulling out of the TSP is going to lose earnings. You're going to pay it back. You're going to pay it back. You're going to pay back your loan. Yeah, your payroll deduction. But in the meantime, the money that you took out is lost earnings. It's lost earnings. We're talking maybe it takes back 5 years to pay back the loan. It's called a all-purpose TSP loan.
No, that makes sense.
The point is, and this is what I tell everyone about this, how long does college normally last?
Hopefully 4 years.
Okay, there are exceptions, we know. Dan, how long is retirement going to last?
The rest of your life.
How long could that be?
Could be 30 years easy.
Yeah, 30 years. You need every penny of that TSP. You need every penny of that IRA. And the money you pull out, even if it loses 5 years, in the case of an IRA, it's going to lose the earnings forever because that money's being pulled out. You're not going to replace it. It's not going to be replaced. Therefore, you should try to not use that particular IRA, the traditional IRA, to take the money out and to pay for your child's college education. I discourage it.
No,
I
makes
really
sense.
discourage it.
Makes sense. Number 8, you talk about student loan interest deductions. What do we have there?
Yeah, I guess we're hearing about student loan payback now. We had a couple of years the federal loans did not have to be paid back, but now they're paying them back. There's been some relief, but now a lot of individuals are paying back student loans, and they have to pay it, and they're paying interest on those loans. They paid it; they have to, including interest that they're on the loans. They got to pay it back. Well, there is some relief, and that is up to $2,500 of student loan interest will be deductible as an adjustment to income, That's one of my favorite tax deductions. It comes off the top of your income, an adjustment to income, adjustment to your gross income, resulting in what? Lowering your adjusted gross income. That famous thing. Okay. So $2,500 is the limit. What are individuals coming out of college now are having in terms of student loan debt?
A lot.
It's not. Well, and also, guess what? Say it again. There are AGI limitations.
Gotcha.
Your adjusted gross income, you are paying the loan back. You are you graduated from college or graduate school and you're paying the loan back. If your adjusted gross income is too high, you don't get to deduct it. You do not get to deduct that the interest that's up to $2,500 interest. And let me give you those limits. For 2023, if you're single, you follow a household, if your adjusted gross income is over $90,000, you cannot deduct any of the interest you pay back on a student loan. If you are married filing jointly, if you're over $180,000, there's a phase out there of this interest. The phase out starts when you're AGI single at $75,000 and married filing jointly $150,000 and $150,000. By the way, if you file as married filing separately, you cannot use this.
Gotcha.
You cannot use this. I had a client who do their taxes, and they said, we're really not thrilled about filing in the past. Both spouses work, and they both have a sizable amount of itemized deductions. So we filed married filing separately. We did some calculations. But then they found out they can't deduct their student loans. So I said, let's go back to married filing jointly. Maybe we'll
Gotcha.
look at some of this.
Now, your next three are all in your favorite category, which is tax credits. So first up, we've got the American Opportunity Tax Credit. So tell us about that one.
Okay. The American Opportunity Tax Credit is a tax credit. Once again, a tax credit is a dollar for dollar reduction in your tax liability. Up to $2,500, up to $2,500 tax credit for each of the four years of undergraduate, freshman, sophomore, junior, and senior. This is for educational expenses. And what expenses? Tuition, fees, books, supplies, not room and board though, okay? Not room and board, not insurance expenses, not transportation expenses can be used.
Gotcha.
But once again, there are AGI limitations, okay? And for if you file a single or household, you have a child who's in college, you're the one, by the way, is getting the tax credit, the parent, not the child. If your adjusted gross income is over 90,000, you're not eligible for this credit. For those who filed married filing jointly, it's double the 90,000, or if you're over 180,000, you do not get to use this tax credit now. And if you filed married filing separately, can't do it. Congress doesn't like people who file married filing separately, apparently.
I see that.
Let me just say this, that I've had many questions on this. And one of the questions is that, can my child claim the credit? Can my child claim the credit? My child is in school and he works. He has to file a tax return. Okay? So can my child take the credit? And I explained to the parent, the child cannot be then a dependent of you. You cannot claim the child as a dependent. Now, in this day and age, we do not have dependents. We do not have we don't have a dependence on our tax return. The Tax Cuts and Jobs Act of 2020 or 2017 removed dependents. That $4,000 tax deduction you get per dependent. If it takes $4,000 a year to raise a child, let's say.
Yeah.
So in a way, it makes sense then. Let's say the child, as long as the child has some earned income, just, like they're working, let's say part-time, and they claim themselves, then they can possibly use this credit. Here's the problem. If the child's working part-time, making maybe $5,000 a year.
Yeah.
And let's say their tax liability is $300.
Gotcha.
This is not what is called the American Opportunity Tax Credit, is what's called a non-refundable tax credit. What that means is you only get the benefit of the full amount of credit up to your tax liability. If your tax liability is less than $2,500, you're only going to get the benefit up to what your actual tax liability is. And
Gotcha.
you cannot carry forward to future years.
Gotcha. Well, that makes sense. Well, number 10 has a great name, lifelong learning credit. So tell us about that one.
Yes. Yeah, this is a tax credit of up to 20%, up to $10,000 of higher education expenses paid by an individual. The lifetime learning credit can be used in the same year as the American Opportunity Tax Credit. Remember, I mentioned that the American Opportunity Tax Credit can only be used for the first 4 years of undergraduate, but the lifetime learning credit can also be used at the same time, can be used together. But then let's say the child graduates from college and goes to graduate school. It can be used for the lifetime learning credit can be used there, lifetime learning credit. Or, and you're like this, let's say an employee wants to go back to school.
Sure.
To enhance their skills. Like, I'm sure you have employees, Dan, who like to go back, let's say, enhance their computer skills.
Yep.
Whatever they do, maybe for whatever reason, maybe to come more up to date on security,
Sure.
Things like that. They're trying to enhance your skills. Now, gotta be careful here, though. If you go back to school, let's say you're an employee and you're going back to school to pursue another degree.
Yep.
Can't be used for that. It's only used to enhance, to help you enhance your skills in your current job.
Gotcha.
Now, if the employer pays it, obviously, for that education, the employee cannot use that as a basis for the credit. The education that the employee is getting to enhance their skills, they're paying for it. They're paying.
Got to be out of pocket. Got it. And the last one might not be as obvious, but it's the child dependent care credit. So again, this is for younger kids. How might somebody use that? Yeah.
As we know, the cost of daycare is expensive. So, and this has been around for a while. It's called Dependent Care Tax Credit. We talked about the Dependent Care Assistance Program. This is a tax credit. So what it is that if an individual is working and if their spouse is working, and they have to put the child in some type of daycare, including nursery school or a child care center, or somebody comes to the house to take care of a child. It also can be used for a dependent adult. You have an adult who lives with you, who has to go to an adult daycare center, or somebody comes to the house to take care of you. Well, there is a tax credit of $600 max. $600, which would be for individuals who, I think it's $600. That doesn't change that up to $1,200 for more than one individual. That's a tax credit that you take on your income taxes. Keep in mind, though, that in order to use this credit, I mentioned that the person has to be working. If the person is married, their spouse has to be working, unless the spouse is going back to school and
Gotcha.
They have children or adults that have to go adopt in dependent care. That the person or institution, the person that takes care, comes to the house, has to be licensed, and you have to fill out all the information about the person in terms of their name, social security number, and in case of a daycare center, it has to have an EIN number.
Gotcha.
There was a lot of abuse in this in past years, and Congress cleaned it up. But it's a tax credit. It's a tax credit. Not much. Once again, you're limited up to $3,000 per dependent that's one, and $6,000 as a basis for the credit for more than one dependent. $6,000 for more than one dependent. Once again, I have clients, they run through the $6,000 by the last week of January because
Sure.
we have three children who are in child care centers.
Oh, yeah.
They haven't raised the limit in 25 years.
Yeah. Probably overdue for that. Overdue. Well, Ed, I've said it before and I'll say it again. No one is really writing and covering topics like this for feds except you, brother. So that is awesome. So, Ed, on behalf of all the feds, I want to say thank you for being such a great resource. Folks, that is a wrap. We are Serving Those Who Serve. Be sure to hit that subscribe button on this podcast on a YouTube channel or also on Spotify if you are a listening type person. Remember to share it with your friends and neighbors. Don't forget, I'll have webinars every week. Just head over to swserve.com. You will see the blue webinar button. Touch it. It turns red. Click it. It's going to take you to the whole menu. Tons and tons and tons in there. The guru will come to you. Reach you where you are, teach you where you are, serve you where you are. Sign up for one, sign up for all. Share it with your friends. They will thank you. Be sure to read Ed every single week in the Fed Zone. That's fed-zone.com. So for Ed, the crew at Serving Those Who Serve, and me, Dan Sipe, I will sign off as I always do by saying, good luck, Godspeed, and above all, remember, it's your Fed life. Make it a great one because you deserve it. Stay well, everybody. We are out.